Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Okay, so I would like to officially welcome you to the very first episode of the Going Long podcast. I'm your host, Billy Keels, and I am super excited to be here today because we're going to talk about something that is really close to my heart, and I'm sure that it's close to your heart. And we're going to do that with someone who is an expert who's figured out the formula on how to connect not just financial freedom, but to do that with real estate. And today's guest is no other than Tyler SHEFF. Tyler has figured this out. And so today, like I said, he's going to be sharing a lot of his secrets and a lot of his tactics that he does to help combine, once again, this financial freedom and real estate. So Tyler, really excited to have you here. How you doing today?
Billy, I'm blown away that I get to be the first guest. This is really cool. It's a huge, huge honor for me. So I'm pretty excited to be here today.
Well, I'm definitely excited. And so Tyler, know a lot about you. You've known one another also too, just everyone. Tyler, aside from being the founder of the Cash Flow Guys, who's going to talk about a bit more in just a couple minutes. Tyler is someone who has been a mentor to me, someone who has been a sparring partner for me as well through my evolution in real estate. And also someone that I consider to be a friend. So it's really a pleasure to have you on, Tyler, in our very first episode. So, Tyler, I just want to get right in because you have so much goodness to share with everybody. And as I thought about really going long and what that means, every one of us is on a journey as we get started in life. And for a number of different decisions that we've made and actions that we've taken, we've landed at this point in our life. And so I know you have a fantastic story to tell, Tyler. So if you could help our Going Long listeners to understand really who is Tyler SHEFF and what have you done to get to this point in your Going Long journey?
Be happy to. And I got to say, as to you, you're part of the reason why I was able to obtain the success that I've had. If I didn't have that sparring partner, that person I could count on the other side of the country, or the other side of the world rather, to bounce ideas off of, to practice closes with, you remember all those years ago, we used to get on the phone and practice the closes. And I can't begin to articulate how much that has helped me over the years. So thank you for your friendship as well. As far as Cash Flow Guys, it kind of got started. I used to work for the federal government, had the cushy 6-figure year job, real easy job. The only downside of that is I had to travel around the world. And you'd think, well, it's not a downside, but it is when you got 2 teenage daughters and a wife at home. And then, of course, my wife, folks don't know, my wife was diagnosed with MS, which is a debilitating disease. And over time, it starts to really have a pretty solid impact on your life. And what really made the change for us is her sister. She's an identical twin. Her sister also had the same disease. It eventually took her life a couple of years back. But we realized that it was very important for us to live our lives now. We didn't want to fall into the trap of work for 40 years, you hit 65, next thing you know, you're on a fixed, quote unquote, fixed income, and you have to live based on whatever the government will hand you in some sort of a retirement plan that may or may not last through your retirement. Clearly, that didn't really make a whole lot of sense to us. We decided we wanted to do something different. Cash Flow Guys was basically a brand that I started because I learned that through my journey, I was probably going to make a lot of mistakes. And I think that mistakes, primarily, they're important because you learn, and I wouldn't be who I am today without those mistakes. But if I could help somebody else not make those mistakes, avoid making those mistakes, maybe give them more chances up at bat but without striking out, that would be a good thing. That, I could kind of my way of giving back, but at the same time, holding myself accountable. That's kind of how Cash Flow Guys came. And in 2014, I walked away from that 6-figure job because I had decided that I was going to pull the trigger in real estate. And my wife and I talked about if I could replace half of my income in 6 months, I had 6 months of paid leave saved up. I took an extended leave. If I could duplicate my income during that 6 months in real estate, then I would go ahead and resign my position with the government and go full time as a cash flow investor, not necessarily a house flipper or anything like that. And that's exactly what we did.
Man, that's fantastic. So you had a real reason why you made that decision, you made that change. And maybe if you could talk to us a little bit more about that. You said something there towards the end where you decided that you wanted to be a cash flow investor versus a house flipper. Can you help us understand a little bit what is the difference between the two, and why did you make the decision of cash flow versus doing something like flipping?
So many years ago, back in year 2000, I got my real estate license, and at the same time, I decided I wanted to flip houses. And I'll admit, I was very good and also very bad at flipping houses at the same time. I was very good in that we did very well on the flips. They were very profitable. We made lots of money. The problem is at the time, I didn't really have the business sense to know what to do with the money when I did have it, nor was I adequately prepared for the tax implications. I got hit really hard in 2005. We had a great year in sales wise. The problem is tax wise, I didn't allocate for the taxes. I didn't plan properly. I got hit hard with the taxes. And the problem is that being a much younger guy with a lot less emotional intelligence than I have these days, is I didn't have the money to pay the taxes and had to deal with the U.S. Internal Revenue Service, which is rather costly. Long story short, as my wife's health started to degrade, and we decided we were going to get into real estate as a way to replace that government paycheck and replace her paycheck to retire her. We looked at flipping as a model, but then realized that, well, although their gains are there, there's also the pretty high opportunity for losses. And to be honest with you, we're 49 and 50 years old. We're not at a position in our lives where taking unnecessary risk makes a lot of sense when it comes to finances. We want to be a little bit more certain in what we do, a little more calculated. The buy and hold strategy, number one, instead of being a tax liability, it allowed us to mitigate or to reduce our taxes considerably. At the same time, it freed up a lot of our time. Flipping houses and sourcing all these individual deals one after the other, it's very time consuming. We wanted to travel the country, which is what we're doing now full time. We wouldn't have been able to do that and flip houses at the same time, because essentially we would have exchanged our W-2 jobs, the one job, for another job, and that's called flipping houses. As a buy and hold investor, active or passive, you can spend a lot more time working on the business than you can working in the business, as compared to flipping, where it's the exact opposite. It's literally the flip flop. You're working in the business because it's the only way you can get things done. So for us, the buy and hold strategy was full of great things that were necessary for us to live the kind of life that we wanted versus the flipping. So the flipping, basically, we brushed that under the carpet and never looked back. A lot of folks think that they need to flip to either get a certain level of experience before they buy and hold, or to save the money to buy and hold. And I think that is probably and I hear a lot of people give that advice. And I got to tell you, that's probably some of the worst advice you could ever receive or take in that case, because I have honestly never met a flipper that has successfully transitioned to buy and hold real estate 100%. It's similar to taking a drug. Once you start, maybe you're a smoker, it's very, very difficult to quit. And I frankly have never met anybody who has successfully transitioned 100% out of flipping into buy and hold. I know lots of investors that have started in buy and hold and done very well for themselves, but that transition becomes very challenging.
Yeah, so I mean, there's a lot there, right, to be able to unpack. But I think as you're making that transition, it sounds like you went through the process. You realized that by being able to focus on buy and hold type of investments, that it allowed you to have more time, more money in your pocket, and paying less taxes, and doing that all legally.
Absolutely. One thing that people tend to overlook when you're considering what type of strategy you want to do in real estate, and I find this a lot. Let's say you make 150 a year. People feel they need to replace 150 a year in income. That's absolutely not true, because I don't care where in the world you live, you're going to be subject to some sort of taxation. If that 150 is a gross number, and let's say your net is, just for loose math, 100. So let's say you make 150 gross, you net 100. The only thing you really have to replace is the 100. Obviously, there is tax implications when you do anything involving a gain in real estate or whatever, but depending on where you're located in the world, how you earn, and the one thing that you can always ring true is how you earn your income will determine how you're taxed. I don't care where you live in the world. Every government across the world taxes you based on the method of how you earn your income. In the US, for capital gains, can be quite pricey, and that's a lot of the reason, the advantages over here to invest in real estate for long term.
Yeah, I think that is that's key, and it's one of the things that I think a lot of us tend to not think about so much is how you're actually earning your income, Tyler. And that is, I love that example to really show how you can start to look at what you need to replace. Because a lot of times people don't really know where should they start. And so to
Right.
use that example, rather than trying to replace 100% of your salary, looking at the portion that's really coming home to you net is something that probably a lot of busy professionals don't necessarily think about. So I guess one of the questions I did have is, and I guess it builds on that from the busy professionals. So you deal with and speak to and educate lots of really busy professionals.
I do.
And could you maybe help us understand what are some of the big reasons or some of the biggest things that you see that busy professionals that they're looking to achieve when they're looking to invest in US based real estate?
Well, I think coming from Europe in general, in Europe, it's the common practice, at least it's my understanding, that people generally invest for appreciation. Investing for monthly cash flow is a little more challenging. And I know this is the case in Europe and in Australia and New Zealand and lots of other countries like that.
Mm-hmm.
And I think that a lot of times when folks look to invest in the US, they're still stuck in that mindset that I need to be appreciation focused, which appreciation is absolutely necessary. Don't get me wrong. But instead of focusing on that over here in the US, you have the benefit of focusing on monthly income. You can actually invest here. You can buy an improved property and hold it for long term and earn that monthly revenue. So that's one of the things you should be looking at right out of the gate.
Mm-hmm.
And in my opinion, when you focus on appreciation more than you focus on cash flow, that is when you're going to find yourself overbuying or overpaying for a property because you're absolutely speculating. You know, speculating for me, I don't like to use the word speculating because it makes it sound like you have some sort of finesse. Speculating is a guess because you cannot control the future, right? When you're speculating based on appreciation. Cash flow, on the other hand, if you've got financing brought into the equation, let's say you use some sort of institutional financing or you invest as part of a trust or a REIT or maybe a syndicate, and there's not a lot of, there's a fixed rate financing in place, the cost and expenses, there's historical data to know where those lie. Mm-hmm. You can have professionals come in and inspect the properties prior to the acquisitions, things like that. So there's a lot of knowns going in versus on the speculation side, there are very few unknowns. There is some relevant data points to pull off of, but again, those are different people's deals, different scenarios. When you're investing in for monthly cash flow, if you make that your primary focus, the appreciation will happen. Absolutely guarantee you the appreciation will happen. Here's why. When you invest for cash flow, for income producing assets, the value, especially in the commercial sector, which let's say we're talking about housing, multifamily housing, 5 and above units, primarily the value is going to tie to the income it generates. They'll use things like cap rate and other metrics to determine the income. So that said, if you're income focused and the properties are performing well monthly over a consistent period of time, the appreciation will follow automatically. Regardless of what markets do and whatnot, because when you buy a cash flowing asset, you are buying a stream of income. That's essentially what you're buying. The properties that don't perform are the ones that lose value exponentially. The ones that do perform are the ones that appreciate exponentially. And that's really how it works.
Okay. So, and this is, as you said, right in the beginning, this is one of the areas where maybe a lot of times outside of the United States, it's a buy low, sell high, very similar to what we see in the stock market. And so that would be your capital gains when we're talking about cash flow, which is something that we may not necessarily see a lot outside of the United States. There exists the possibility of actually having the ability to earn money every single month.
Yes, absolutely.
Which is great. And, Tyler, when you are dealing with and also educating lots of busy professionals, because I know that is a large part of the cash flow guys and what you do. What do you see as some of the biggest reasons for people not to really move forward or not to get started in real estate?
Well, for one, I think there's almost seems this may sound crazy, but it seems like sometimes there's too many options out there.
Hmm.
There are so many different types of investing strategies available. It's tough for most people to figure out which one to invest in. And what you'll find sometimes is that folks don't really reflect too much on that. They don't develop that investor identity before they get started as an investor. They invest in an asset class that they haven't really spent any time researching. They've researched investing in general, but not a specific class. Let's say you're talking about non-performing notes. I know people that have bought non-performing notes having no idea what to expect outside of the potential profit margins, and they are unpleasantly surprised when they haven't considered their investor identity. These are people that maybe thought that they wanted to be a buy and hold investor. They wanted to buy rental homes or apartments or things like that. Maybe they want to invest passively. And one of these shiny objects got passed in front of them. And they thought, geez, here's a chance for me to make again, we're speculating that chunk of money that we can further invest later for cash flow. And I see that being a big mistake that folks make investing over here in the US. It's just too many options. Instead, drill down that investor identity. Ask yourself, why am I investing in this? Why is this important? Do I understand it? Do you have to be an expert in it? No, but do you understand it? Do you understand the concept behind it? Do you understand where the profit comes from? And again, that's something that a lot of folks overlook is I can show you all kinds of numbers and data and spreadsheets and all these different metrics, and that's all fine and dandy. But what evidence exists out there to prove this number? A safe, strong, good investment is something that should stand by itself. In other words, it should be able to prove itself. It should make money. If you're going to force equity or things like that, I get that there is a certain degree of speculation, but realistically, all the data points that are presented should be verifiable. You should be able to see that, well, if we buy this apartment building and the rents in the area are $750 per month, and the pro forma or the prospectus says that they're going to do $900 a month, my question would be, where does that extra $150 come from? Well, we think we can do better. How can you do better? Well, advertising. Okay, that's great, but nobody else can seem to figure that out in the market. What makes your advertising so amazing that you get an extra $150 a month over 100 units or whatnot? These are the important questions that you're going to want to ask yourself as an investor if you're doing a deal on your own, or your sponsor if you're investing in somebody else's deal.
Okay. So as you see that their investors are looking to passively invest, so they're maybe stopped up because there are too many options, one of the ways that they can start to really focus on what makes most sense for them as potentially investing themselves, or as you mentioned, as a passive investor, meaning doing that with someone else, is to really get clear on their own investor identity. I love that, Tyler. That's fantastic. And you talk about something, and we also want to use this time to help to educate and not necessarily drill into it, because we have a number of our audience that is not necessarily familiar with one of the topics that you talked about now. But could you just give us an understanding as to what are notes and how could someone potentially look at that and that could become a part of their investor identity? Maybe just to give them a very kind of clear example.
Notes, I can go on for hours on notes, but I'm gonna try to keep it real simple. So basically, when you go buy a house anywhere and you're gonna go borrow money, that generates a promissory note or some type of instrument that is basically a promise to pay. That instrument has value, and in a lot of cases, and in my opinion, that instrument has more value than the actual asset that it's secured by. So that promise to pay. So if Billy comes to me and says, Tyler, I want to borrow $100,000. Great. What collateral do you have? Well, I have this flat. Great. So Billy decides that for whatever reason, Billy has a hard time, can't pay his bill anymore, can't keep up with his loan payments. I could come in and I could sell that note to somebody else, because the reason why Tyler loaned the money is because he wanted it back, right? He wanted those monthly payments. And for whatever reason, the payments have stopped or whatever. I can now sell that note to somebody else, that instrument to somebody else at a discount, granted. So let's use $100,000 as an example. I loan out $100,000. Payments are made until the balance is down to like $80,000. I decide that for whatever reason, I need to sell that note. I want the rest of the cash now. Well, I can't get all of it right up front, the whole 80,000. But let's say I decide to sell it for 70,000, so $10,000 less, to another investor. You may ask, why would anybody in the world do that, and why would I do that? Well, if you're on the buying side of that, you just picked up a $10,000 profit, because if you simply wait for the payments to come in, you'll receive the entire $80,000 even though you only paid $70,000 for that right to collect those payments, and that's where your margin lies. What a lot of times folks will do is they trade these assets, kind of like stocks, as a way to recapitalize. Let's, in the same example, I'm willing to sell this note for $10,000, last for 70 grand, because I found a better note that I can make a $20,000 spread on. So it makes sense for me to take a $10,000 hit to then use that money to make 20,000, if that makes sense. And that's really note investing in a nutshell. Now that's more of the trading in the non-performing side. On the performing side, you borrow $100,000. Let's say it's at a 6% interest rate. You're going to earn 6% interest on top of that money every year for as long as that loan is out there. And if they have it for 30 years, well, that turns out into a pretty healthy, uninterrupted investment that's secured by real estate. In the event they don't perform, they don't pay the bill, you get the ability to foreclose on the home. It goes to the court, depending on what state you're in. There's a lot of laws revolving it around it, but the asset, you have the ability to foreclose and take the asset back as collateral, then sell that. In a perfect world, the asset is worth more than what you loaned on it. So if you sold the asset and it was in good condition, there would be additional profit in there, which how much you get to keep of that depends on individual state laws, but that's really note investing in a nutshell.
Okay, and that I love that example, Tyler, because in as we tie it back into what you were talking about before on the investor identity, if you can look into a specific area of notes and the explanation that you've just given of, if that resonates with you, that may be a path that you want to continue down as an investor. So I think that ties in really, really well, Tyler, to give us a very concrete example as to how understanding a specific area of real estate, in this case, notes, performing and non-performing, can tie back into your investor identity. If those things that you were talking about really resonate with you, it gives you an example, and you could do something very similar if you want to talk about multifamily investing or storage, et cetera, et cetera, et cetera. So
Absolutely.
thanks for that. So Tyler, I want to spend a little bit of time in having you help us understand more about cash flow guys. Talk to us about cash flow guys. What is your goal, and kind of help us understand where cash flow guys came from, and what's the mission of cash flow guys?
Well, initially, Cash Flow Guys was a way for me to document the process of learning for my wife and I. It was a way for us to, knowing that we're going to make a lot of mistakes throughout the process. If I could document this whole process, show those mistakes, be transparent, there's a pretty good chance that somebody else may come behind me, see the mistake that I've made, and kind of sidestep and avoid that mistake. I thought that was a big benefit to put out to the world. Second, Cash Flow Guys was born as a brand really to hold me accountable. It forced me to become better at what I do as an investor. It's very easy to fall into a rut as an investor. You learn one thing, you run it, and we all get lazy. It happens to all of us, right? We commit to doing something, and for example, New Year's resolutions. New Year's just passed. Everybody has a New Year's resolution. I'm going to join a gym. I'm going to do all these different things. You don't follow through. Well, when I committed to Cash Flow Guys, that came with the Cash Flow Guys podcast. I decided to start the podcast as a way to, number one, communicate with people, to attract opportunity and investment capital and these type of things. But second, to hold myself accountable. It's something that I know every week I have to put out new content, new valuable content that helps people. For me, I'm up at I'm well over 200 episodes now. I've been doing this for over 4 years, putting out this content. No matter what, there's no excuse for me not to get the content out. There's been 1 week that it was an hour and 20 minutes late. I was in Puerto Rico at the time, and we had a technical problem in the mainland. And long story short, we got it out, but my inbox exploded because it was like an hour late. People thought, "Are you okay?" It's like, well, by the way, that's on autopilot. I don't actually push a button at 7 a.m, but whatever. So for me, it was a huge accountability thing, and it really got me focused on bettering myself every day. I'm an avid reader, and I even got lazy with that. I didn't read for a couple of years. I get tied up in social media and all the distractions of life. Mm-hmm. I know that to be a better person, to be a better investor, to be a better husband, father, I need to continually self-improve. Cash Flow Guys has become that vehicle for me. I know that I have to stay on top of trends. I need to learn about what's going on. I need to learn about the pitfalls so that I can help the people that listen to my show and my podcast avoid these things and make themselves bigger, better investors. And that's really, in a nutshell, what it has grown to be.
Fantastic. That's fantastic. And we're going to come back to the cash flow guys, but I guess as we start to think about just a couple last questions, um, one of the things, especially for lots of people that are going through and wanting to learn more about U.S. based real estate, there can be this desire to want to do everything perfectly, right? When we're
Right.
in the corporate job, we if we get things wrong, we take that as a bad thing. Mistakes are not necessarily accepted, but and I appreciate your vulnerability, Tyler. And if you could just share with us, kind of in your journey over these last couple of years since getting back into real estate, maybe if you could share, I don't know, what do you think has been your biggest mistake, and from that mistake that you made, kind of how has that helped to make you and the cash flow guys an even better, stronger person and company.
I can tell you, I did early on. I did one deal that I'll say was not a great deal. It was I've had deals go south. Everybody does. It's part of the deal. But this deal, I took a lot of the things that I should know better, a lot of the things that I should have considered, and I allowed my ability to perform. I didn't want to be judged for not performing on a deal. So I overlooked a lot of things, a lot of red flags that I shouldn't have overlooked. And of course, those red flags were correct. There were a lot of issues with the deal. We were able to exit the deal in good shape. It all worked out in the end. But what that made me realize is that gut feeling, that training, when you spend time learning how to analyze deals and focusing on where the money's coming from and proving where the profit comes from, when you really hone in on that and you understand how to analyze a deal, this is why I put together a free course just for that purpose, to teach people this little element. Don't ever talk yourself out of that, because the numbers never lie. And when I overlooked that, it stung me. But since then, what's made me a bigger, better investor is that I am 100% numbers focused. In other words, if we can't justify where the information comes from, or we can't verify the validity of the data, if we say that if they say the rents are 900 and we know they're 750, then we're going to go with 750, because that's the right thing. We have a fiduciary responsibility to our investors and our partners to make sure that we vet every different data point that we look at and everything that we consider when we make a go no go decision. I no longer ignore any of those flags. When those flags are waving, I use that as rocket fuel to negotiate a better deal. I believe that any deal can be worked out, provided there's enough motivation on both sides. However, where I used to look at some of those things and go, well, we can sort that out later. We can maybe put granite countertops in and overcome that. Now, we're going to negotiate a better deal up front. So it makes me negotiate harder, which makes me a bigger, better investor, in my opinion.
Okay. Appreciate you sharing that with us. And so mistakes are part of the process when that means you're taking action. And sometimes, and even experts like yourself can get maybe overlook things, or maybe want to I think, as you said, you wanted to be able to move forward. Something kind of told you in the gut it wasn't right, but you didn't want, maybe your ego got in the way, probably paraphrasing a little bit, because you wanted to demonstrate you were performing. What that's allowed you to do, and one of the things that you're sharing with others as part of your due diligence process, and I know you said you made a course about that, a free course, it has allowed you to really be focused on the numbers, so that you make sure through your due diligence process that you're working on the right things for yourself, for your investors. And so out of that, what probably was perceived as negative experience, it's made you even stronger today. That's fantastic.
It has. And that said, the one quick test that I've come up with to really, before anything you consider anything, is will you talk about this deal to your sphere, to the people around you? In other words, if I could call Billy and say, Billy, I got this great deal, and here it is, and here's the income, and here's the expenses. If I'm great pitching that deal to Billy, I know it's not Billy's deal, it's my deal. If I'm not embarrassed to talk about that deal, if I'm excited about talking about the particulars of that deal, that means I've got a great deal in front of me. If I call Billy, if Billy says, hey, have you worked anything yet? Well, yeah, I am negotiating on this one thing, but it's probably nothing. That tells me that I probably shouldn't do that deal, because I'm not excited about it.
Okay. All right. Well, and that is that's a good litmus test. I like that one. I'm going to start using that one myself.
Yeah.
So Tyler, I know you mentioned that you're an avid reader. I would like just to have a couple of action points, and because you're an avid reader, and there are a number of things that you talk about, you're always staying up to speed. I guess, especially for those of us that are looking at understanding more about whatever in the United States, real estate. Could you maybe share maybe one of the readings that you've had recently that has really made an impact and could also make an impact on our audience?
I can tell you, boy, I'm trying to think of the name of it now. Robert Helms and Russell Gray Russell Gray and Robert Helms. Boy, I got that backwards, didn't I? From the real estate guys. They have a book called Equity Happens. And I think that, I'm not sure if they've released the new one yet. They were getting ready to update it, but I've read, I could say, thousands of books as an adult now and over the years. And I'm on a goal right now. I'm working on a book to 2 books a week. That said, that book, Equity Happens, which is out of print, but you can still get it on Amazon if you wait for it. Equity Happens is probably one of the best written, most comprehensive guides to investing in the U.S. that I've come across yet. And I think I've read just about everything in print that's worth it. That's for sale on Amazon anyway. So I'd strongly suggest you pick up a copy of that. And I think they're getting ready to update a new release to it. So watch for that.
Okay, fantastic. Greatly appreciated that. So Equity Happens. Check that out if you can find it, and also be ready for the new updated version that's going to be coming out. I guess just Tyler, as we get ready to wrap this up, everybody's at a point in life where you're looking to understand more, you want to learn more, and maybe there's some trepidation about actually making the mistakes, like we were talking about just a couple of minutes ago. Now, you've done things to be able to get out of your own head and be able to take action. And so for those of us that are maybe still waiting to take action, if you could kind of provide us with something that's worked for you to be able to help you to take action, to figure out what's behind that door. I'd really love if you could share that with everyone today.
I can tell you the most comprehensive system of learning that I've ever been able to partake in, and this is going to blow a lot of people away. It's a cash flow 101 game, a simple board game that if you play it, and they have the app, you can get it on the App Store or Google Play or whatever, or you can buy the board game and play it with your friends, play it with your family, because it allows you to actually get in the investing, to make investing decisions. And the good news is, using monopoly money, fake money, you're not using your own money. So essentially there's no risk to you outside the $50-$60 it costs to buy the board game. Outside of that, there's no risk at all. And if you look online, if you Google search or go on Meetup, you can probably even find somebody that's hosting a cash flow event, cash flow game in your area, no matter where you are. I know you do them. You used to do them there in Barcelona, and I used to do them in Tampa Bay area. And actually, students of mine have carried on the tradition, and we've got 3 different cash flow games running now in the Tampa Bay area. So if any of you are listening to this from the Tampa Bay, Florida area, stop by one of our events. That playing that game, it helps you exercise that decision muscle. It helps you get a good handle on your investor identity, because you're going to learn more by doing than you ever will by standing back, reading books, and going through the education process. I think that when you sit down and play the game and you start making these decisions, some of those decisions you're going to realize this type of identity is just not for you. But other things you may look at and go, well, maybe real estate isn't my game. I'm more comfortable investing in businesses. Maybe I'd rather invest in a business or buy into an existing business, or maybe I'm going to play the stock market because I like the idea of the gamble, the speculation. The Cash Flow 101 game is going to help you mold that without putting yourself in harm's way. And I just think that's probably one of the best ways out there.
I think that's fantastic. And I know I've seen you, Tyler, as you host the games, and I know the feedback is phenomenal, the way that you create the learning environment. And so just reiterate, as you mentioned, especially if you are in the Tampa Bay area, if you're fortunate enough to be there, and you can look up Tyler while he's doing hosting one of his Cash Flow 101 games, it's absolutely one of the best ways. So I appreciate you sharing that, something very practical that anybody can do. And also, if you happen to be in the Barcelona area and I'm hosting a game, it'd be great to see you here as well. So listen, Tyler, this has been, for me, just a blast. I'm sure for our listeners, our viewers, it's been the same, been able to take away a lot of actionable content. And it's been great to understand, and also to see how you are really taking real estate, the results that real estate can provide, and you're making the lifestyle that you want to live today, not into retirement. You figured out the formula that has allowed you to earn more money. It's allowed you to have more free time. It's allowed you to pay less in taxes, doing that legally. It's allowed you to go out and also help to educate and influence the marketplace. So it's a pleasure for me, like I said, to have you on today. And I'm sure that there are a number of people that really want to find out more about Tyler SHEFF, want to find out more about the Cash Flow Guys. So as we wrap up, if you could just tell us, how can we find out more about you or get in touch with you?
The best way, the most comprehensive way, is go directly to cashflowguys.com, cashflowguys.com. You can type that same name in, or my name, Tyler SHEFF, SHEFF, into Google. You can type that into YouTube. I've got a YouTube channel. Of course, the Cash Flow Guys podcast is available on every single podcast player out there. And we're pretty easy to find. So if you just type in Cash Flow Guys in separate words, Cash Flow and Guys, you'll get all of our social media, all of our education materials, and the whole 9 yards.
Fantastic. So Tyler, thank you so much for being on the podcast. So all of our listeners and our viewers, once again, this is Billy Keels with the Going Long podcast, and we are looking forward to seeing you and having you listen to us on the very next podcast. Make it a great day, everyone. Wow. Don't you love hearing from top-notch experts in the field? You know, when I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you like today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.